So today's topic is how to create wealth in the current economic climate. How to create wealth in the current economic climate. If you have any questions during the presentation, please do well to type them in the chat section here. Or for those of you who are streaming live on YouTube, you can type your questions under the comment section. And when we get to the Q&A session, we'll make sure that we respond to all the questions. Our speaker for today is in the person of William Mensah. William is an executive director at Bora Capital Advisors, and he has over 17 years of experience in investment banking, which includes portfolio management and private equity. William has joined us today. William, can you hear me? Okay, just a second. William, can you hear me?
Okay, I can hear you now, yes.
Okay, great. All right, so I'll leave you to present, and then I'll be back for the Q&A session.
Okay.
All right. Thank you very much.
My screen is visible?
Yes, it is.
Okay, thank you very much. So thank you very much, ladies and gentlemen. We are living in very uncertain times. It really doesn't matter where you are, whether you are in Ghana, whether you are in the Americas, or whether you are in Europe. We are all experiencing uncertain economic times. The question is, what do we do? Are there any opportunities that are available for us during these uncertain times? How do we take advantage of them, and how do we create wealth even in the midst of uncertainty? So that's what we want to focus on today. So for our presentation today, we will look at where we are now, both domestically and across the world. And then we'll look at historic landscapes. You know, most of the time when we go through some kind of upheaval, there's always the saying that, oh, this time is very different. The circumstances are very different. It's very different. And the same thing happens when there is a boom in the market, when we are going through any kind of bubble. To say, oh, this bubble is different. We don't call it a bubble, it's different. This time there is something, but we would see that we've gone through these cycles so that you don't get too disillusioned about what is happening now. Now, what are the opportunities that are created in this uncertain times? You know, it is said that financial crisis and uncertain times are periods of wealth transfer. There are opportunities that arise for wealth to be transferred during this period. So we'll look at what the opportunities are and how we can take advantage of them by looking at a win-win strategy. Okay. So we'll try and look at the global picture, but I must say that a lot of the discussion will be centered around Ghana, but not only Ghana, but the focus will be Ghana. Okay, so what's happening now? The World Economic Outlook, IMF, says that a tentative recovery in 2001 has been followed by increasingly gloomy development in 2002. Why is that so? Because we went through 2000 and then 2001 trying to come out of COVID-19. So we all had the shocks of COVID-19. And just before we could come out, just when things looked like we were coming out, then Ukraine followed. Now, so the global GDP is now projected to slow sharply this year. Okay, global GDP is expected to grow around 3%. It remain at a similar pace also for 2023. You know, so this is one of the major factors in recent times. Some data came out of China, and they said that China's growth is slowing down. China is not projected to grow as much as we thought China would grow. And immediately that news came out, there was panic all over the world. And then also we all know the problems that has arisen since Russia and Ukraine went into the conflict. Russia and Ukraine, they account for 30% of global wheat export and 20% of corn. And then they are also very significant in fertilizers, natural gas, etc. Now, so you can see that prices of all these things have gone up, which is leading to a global trend where inflation is spiking everywhere you look in the world. And once inflation spikes, central banks start implementing monetary policies that are supposed to tighten things up with the aim of correcting inflation. Are these measures working? We'll talk a little bit more about that when we look at what Ghana has done so far. Okay. So where are we in Ghana? Those of us here in Ghana, we can very much testify that things have been quite turbulent. We've seen increases in petroleum prices. We've seen a sharp depreciation of the currency. And because a lot of the things that we buy here are imported, that high depreciation of the currency has led to increasing inflation. Inflation has been going up steadily, and then we are now at 31.7%. It is more than 20 points outside the country's inflation target, And then it's the highest inflation rate we have seen since 2003. So we are in quite murky times. So Bank of Ghana's inflation targeted monetary policy has meant that they have increased monetary policy. Now, the conventional wisdom is that if you increase the monetary policy rate and then you add other measures like asking your commercial banks to increase their reserve requirements, then money becomes scarce. Okay, so the assumption is that if money is hard to come by, it's going to curb inflation. But these measures haven't worked very well, not only in Ghana, but also in other parts of the world, because the kind of inflation we are seeing is more of a supply side problem than a demand side. Because if it's a demand side problem, then if you raise interest rates, money becomes expensive, it will limit demand, and you would see that inflation will correct itself. But even though it's a supply side problem, once no one country on their own can solve the supply side problem because of how global the world economy has become, all domestic governments also still react to it by increasing domestic policy rates so that they can slow down the inflation at least for a while. So we have seen short-term government of Ghana bills climbing from the end of the first quarter to now. We've seen immediately inflation started going up. We saw interest rates also going up with it. The secondary market is even more dramatic. We have seen yields on instruments go up as more than some yields have more than doubled over the last 12 months. Now, for yields to double, what it means is that prices of bonds must drop. If prices of bonds drop, yields on the secondary market will go up. And then we've also talked about depreciation of the local currency already. We have seen the sharpest depreciation of our currency over the last 10 years. Now, all of this is being exacerbated by what is happening to our credit rating. So we see that our credit rating has been downgraded by all the major credit rating agencies, Fitch, Moody's, and S&P. They've all downgraded us, and we are in CCC territory. Now, once you get into this territory, your economy is seen as outside of investor grade. Okay, so your government issuances are seen as junk status. They are declared junk status. Now, what happens is that there are a lot of international funds that have an investment policy statement that says that you cannot invest in any economy whose credit rating is below investment grade. Now, so immediately you fall below investment grade, all these funds will have to exit because they have to comply. They have to be compliant. The risk of not being compliant is much higher for them than any money they will lose by selling out. Because if you are not compliant, you risk losing clients, you risk being sanctioned and all that. So they have to be compliant. Now, how do they become compliant? It means that they have to sell all the instruments that they hold in that country and exit. Now, if they sell all the instruments and they hold in order to exit, two things are going to happen. One, the price of securities in that country is going to fall significantly. If they fall, it means that some securities are going to be cheap. And then there's also going to be pressure on your domestic currency because once they sell, they need to convert that money to foreign currency in order to expatriate. So you have two strong problems. One, decline in prices of financial assets, and two, pressure on your currency because of the need to expatriate proceeds of sale. Now, but there's this interesting graph I want to draw attention to. Now, we're looking at what has happened in the United States and what has happened in Europe. Inflation started rising in the United States and in Europe before the spike in Ghana took place. Okay, so traditionally, inflation in the US, I mean, when the US has inflation of 4%, it's really, really, really high. So if you look from 2000 all the way to 2022, there's been only 1 year where inflation, 2007, where inflation had neared 4%. Okay, but if you average them out, inflation is 2% or less than 2% over time. Then right after 2020, we started seeing inflation spiking in the US. And the graph is very similar for Europe as well. So inflation started spiking. It went to 4%, crossed the 4%, went to 5, 6, stayed around 5, 6, 7 for a long time. And then eventually they both hit 8%. But look at what is happening to interest rates in those economies. Even though inflation was hitting 7, 8%, interest rates were still at, in 2021, interest rate was still at less than 0.5%. And then it went up March 2022. So the whole of 2021, interest rates were still less than 1%. And now they started going up a little bit because now they started increasing policy rates. Okay, so now you have interest rate going to 1.3, 2%, etc. In 2022. Now, but interest rate is still very far ahead of inflation. Now, you need to understand that interest rates reflect expected inflation, whereas the inflation rate that has been published reflects historic inflation. Okay, so the inflation rate that has been published is comparing prices a year ago to prices today. So that is giving you those high figures. It's historical. Interest rates do not look behind, it looks forward. So interest rates reflect expected inflation. Now, so this is telling us that in the US and in Europe, even though inflation is quite high, the general belief in those markets is that these are temporary hikes in inflation and over time is going to normalize. And so because of that, expected inflation is low, keeping interest rates relatively low compared to inflation. So the real return in both the US and Europe is very, very high. Okay, you buy government instruments are paying less than 3%. Inflation in the US is more than 8%. So your negative real return is over 5%. The same with Europe, 3.4% against 8.9%. Very big negative real return. So this is what has been happening. And it's yes, their spike started right after 2020 all the way to now. Now let's look at the picture in Ghana. Very different picture in Ghana. Okay. Now, so in Ghana, we only started seeing the spike in inflation around 2021. Okay, so 2021 and thereafter. Before that, in fact, At the end of 2021, we were still around that 10-11%, which is where our normal good time inflation rate is. Because if you look at the graph that we have, Ghana, if our inflation rate is low, then it's between 8 and 10%. Okay, so US, when it's low, is 1 and 2%. In our case, when it's low, it's between 8 and 10%. So 2019, 2020, 2021, we were still within that range. Then after 2021, we started seeing the spike in inflation. But unlike the US and Europe, where the spike in inflation went on for a long time before you saw interest rates following, in Ghana, immediately interest rates started rising, inflation started rising, interest rates followed suit. Okay, there was no lag in response. Remember, we are saying that inflation is reflecting what has happened in the past. Interest rate is reflecting what we expect in the future. So really, what the Ghanaian investor is saying, or what the market in Ghana is saying, is that we don't see what is happening as temporary. Immediately inflation goes up, it has a direct impact. So our historic inflation and our expected inflation, there is no difference in the two. Now, is that real, or is that a result of, if I can say, a market inefficiency? It's hard to tell, okay? Because the inflation that is published is based on what has happened in the past. Your interest rate is supposed to reflect what you expect in the future. So basically, what our market is saying is that immediately we started seeing the effect of inflation coming from exchange rate losses and coming from other international factors. Immediately, interest rates started following suit. Basically, the market saying that we don't see this as temporal. We think that there's a problem. I need to be compensated. If I'm not compensated, I'm not investing my money. So that's a clear difference in trend between what has happened in the US and in Europe against what has happened now, where interest rates, last week, we had some instruments sell, one particular government of Ghana instrument maturing in about 3 years, selling at about 38% yield on the secondary market. Okay, and all that was happening most probably because one big investor, following the downgrade in our credit rating, cannot remain in Ghana and has to sell that instrument and exit. And it is exiting at any cost. I just have to get out of here. Staying here means I'm not compliant. I will sell and I'll move out of Ghana. So that's a clear difference. Now, so what are the implications for this thing that's happening? But before that, let's look at the inflation and interest rate trends in Ghana. Now, sorry, inflation and depreciation trends in Ghana. Like I said earlier, you know, anytime we go through a situation where there is very high depreciation in the currency or there is very high inflation, there is total panic, and we take decisions as if what we are seeing is going to be the norm. So we put this graph here for us to see that what we are seeing today, we have seen it before. In fact, I listened to the former, one of the very old finance ministers, Kwesi Botwe, was giving a lecture on the state of the Ghanaian economy some months back. And he made comparison between what is happening now and what was happening back then in the PNBC when he was finance minister. And he said that what is happening now cannot be compared to what happened then, as in what happened then was way worse than what is happening now. Now, the import of what he was saying is that, yes, things have been worse before. However, as to whether things will correct themselves and how quickly things will correct themselves will depend on the actions that you take today. But clearly, you can see in this graph that we've had turbulence. 1999, 2000. 1999, cedi depreciated by 49%, followed by 2000, cedi depreciated by 96%. Very turbulent time. Inflation followed. Inflation hit 59% somewhere in 1995. In 1999, 2000, when we had the massive depreciation in the currency, inflation was getting close to 40%. Okay, but so things looked very bad, but we saw a correction thereafter. Yes, anyone who is a student of economic history will say, well, but the correction thereafter was precipitated by Ghana going HIPIC. So yes, our granddad. So Ghana went HIPIC here, and that gave us a lot of relief. So we can attribute the correction here to HIPIC. But in 2008, we saw another sharp depreciation, 26.4%, followed by 2009, which was also not too good. And then in 2014 and 2015, we saw 2 other years of high depreciation. I remember in 2014, when the city depreciated by 48%, there's this former client of mine, an old professor, who called me very worried, just like people are very worried today, and said, if this depreciation of the currency should continue over the next 3 years, if we get another 48%, another 40 over the next 3 years, then all his wealth would have been wiped out because of the depreciation of the currency. Then I said to him, Prof, historic data shows us that even though it's not an impossibility, the probability of that happening is very little. And I said, Prof, if that should happen, if we should have 48% depreciation this year, the next year 45%, the following year another 50%, worrying about what is happening to your investment portfolio should be the least of your worries, because the amount of confusion and turbulence and unrest that will happen in the economy, what is happening to your investment portfolio will be the least of your worries. So basically what I'll say to him is that it is unlikely that this thing that you are seeing is going to be the normal trend. Now, so we see from 2019, we had 14.8, and then we had 3 following years of very low depreciation. Then all of a sudden in 2022, we are seeing a lot of currency depreciation. Now, this is creating panic. Now, usually the currency depreciations, it arises from 2 main sources, one being fundamental weaknesses in the economy. Now, so the fundamental weaknesses in our economy is what has led to our credit rating declining, right? Now, because our credit rating declined, it meant that we could not go to the international bond market to borrow, which limited our access to foreign exchange. So you cannot support your currency. So that's one. 2, because your credit rating declined, investors have lost confidence in your securities, and they are selling. And when they sell, they have to repatriate these monies, which will also lead to pressure on your currency. But besides the fundamental reasons that causes the currency to devalue, is panic, where people who have no business buying dollars just because of panic, saying that, hey, the cedi is hitting 10 cedi. We may never know where it will hit. Let me go and change my cedis into dollars right now. And we get a lot of that. People saying, I want to withdraw my investment and I want to go and buy dollars. I want to do that. And unfortunately, people only take that panic knee-jerk reaction at the peak of the market when things have really become bad. So usually people do that at the worst possible time, because at the peak of the depreciation is when people get scared the most and they take those decisions. Now, so how are people reacting? People are buying dollars speculatively, and it's all out of panic. People are holding on to their cash. They don't want to invest. Hey, what's going to happen? I'm not sure what's going to happen. Let me hold on to my cash. But the point is holding on to your cash too is that, there's uncertainty in the market, and then also you have inflation. So holding on to your cash also means that the purchasing power is declining. People are selling existing bonds their existing instruments. They just call and say, I want to sell. And then they have not done any analysis at all about what the implication of the sell decision is. Okay, so in the following slides, I've done some analysis for us to see a typical decision that someone will take. He says that I want to sell my bond now, and I want to go and buy dollars. We'll see what the impact of that decision is. And then people are also withdrawing their invested money with no plan at all. So last week, I had to call someone, I think either late last week or early this week, who said he wants to withdraw his money, some millions of dollars. So I asked, what is the plan? Like, what are you going to do when you withdraw the money? The person doesn't know yet. He's just jittery. Why? Because the city is depreciated. Only for him to come back not long ago and said that, okay, he's heard that and Gabet is saying some 750 million is coming following this, that. So now I'm not reinvesting again. But at the time of reinvesting, disinvesting, there was no plan of what to do with the money. It was just a panic decision. Now, if you take that panic decision, what's going to happen? You're going to hold the cash. I think 4 months ago, we had some spike in depreciation of the currency, and then became stable again, and it spiked again. So I think 2 or 3 months ago, we had some people also coming to withdraw some millions, saying that they were going to look for dollars to buy, and they have not secured the dollars. Against all advice, they withdrew the money. After withdrawing the money, I think it was $4 million, they could not find the dollars to buy. And they were sitting with not $4 million, 4 million cedis. They were sitting with 4 million cedis with no dollars to buy. And they had lost the interest that would have accrued on that money for a long time. So we have a lot of reaction coming from people's fear. So that brings me to the quotes, one of the quotes I like from Warren Buffett. Warren Buffett says that, be fearful when others are greedy, and be greedy when others are fearful. Now, basically, human beings in general, we are driven by two very powerful emotions. One is the emotion of greed, and the other is the emotion of fear. The emotion of greed is what makes people participate in bubbles and Ponzi schemes and things like that that have no underlying real value. Okay, so when things are going up, when people hear stories of things doing very well, without any analysis, without asking, is there something fundamentally valuable in what I'm doing, they jump into it. That is the emotion of greed. And a lot of people do that. Fanciful things, like we are seeing in the cryptocurrency space. Majority of the people who are playing in the cryptocurrency space, they have no idea what cryptocurrencies are. They don't know what blockchain is. They don't know what the cryptocurrency they are investing in is solving. They don't know whether there's any value in it at all. All they hear is that it's gone up X amount, it's gone up Y amount, so I'm selling out. I'm not saying there is zero value in cryptocurrency. I'm saying you need to understand what you are doing. And the flip side is here. When things are declining, without asking whether there is a fundamental reason why prices are declining, people just out of fear say, let me exit before it gets to zero. Let me exit before it gets to zero. And people just start selling things on and off. So Warren Buffett is saying that you have to be fearful when others are greedy. It means that the time that you have to be most cautious about investing is when everybody is jumping into something and doing it. In fact, there's this saying, there's this joke that says that when you are going to visit your grandmother and you go in a taxi, and the taxi driver, or in Ghana, let's say you sit in a trotro, and the trotro mate tells you to go and buy a certain investment. Okay, trotro mate tells you, go and buy this investment. And then you get to your grandmother's house, And your grandmother also tells you to go and buy that same investment. If you have any money in that investment, immediately call your broker and sell it off. Because when the trotro mate has heard and your grandmother has heard, it means that the party is over. Okay, but we tend to follow these hypes and jump into things that we don't understand. But he also says that you have to be greedy when others are fearful. So basically saying that in times of panic, where people are selling off left, right, center, that is the time that you have to open your eyes. He's not saying that when things are down, people are selling, just jump into the market and start buying anything at all. Because there are times where there's a very good reason why something is going down, and it may very well get to zero. Okay, but when there's panic, the good and the bad all decline in prices significantly. So when others are fearful, that is the time where you have to open your eyes and start looking for opportunities to buy undervalued assets. And that's where we say times of economic uncertainty are periods of wealth transfer. Now, the wealth is transferred from the people who, out of fear, are selling valuable things very cheap to the people who are able to master their emotions of greed and fear and come in there and pick these undervalued assets that are selling at fantastically good prices. Because in normal times, it's hard to get a very good asset selling at very low price. Okay, so we put together this scenario, which is very typical of what we see people doing today. Now, so you have people who bought bonds last year, the last quarter of last year. You could buy bonds and then about 19.5%. And at that time, we found the 19.5% as attractive. I mean, if you could get 20%, 20.5, you were happy. You know, so typically last quarter, so about a year ago, people were buying instruments that were returning about 19.5%. So let's take this scenario of a client who a year ago bought an instrument, 100,000 cedis, or 10,000, 1,000, whatever it is, the relationship remains the same. So don't let the 100,000 mean, it doesn't mean much in the analysis. Okay. Now, so at a coupon rate of 19.5%, and he bought at par. So let's say he participated in primary auction. So bought at par. So his yield was also 19.5%. Now the term to maturity was a 3-year instrument. But now because interest rates are around 32%, 33% for this instrument, the current price on the bond is only 88.5% of face value. So meaning that if you decide to sell this bond today, even though you paid 100,000 for it, you are only going to get 88,500 cedis when you sell it. Because the person who is buying from you needs that discount to compensate him for the fact that this bond is going to pay him a coupon of only 19%. So that now when he calculates his return, we call it a flat yield or the current yield. When he calculates that return, he will be dividing the coupon, the income that he's going to receive, not by 100,000, but by 88,500, so that you get something much higher than 19.5%. So typically that's what happens. Now, but if this person decides not to sell the bond, that's what is going to happen is that every 6 months, he's going to receive 9,750, half of the 19.5% on the 100,000. Okay. But now he gets to reinvest that money at current interest rates. Okay. So we're saying this is the last quarter of the year, and the coupons are paid every 6 months. So he received the first coupon around, let's say, March this year. So he could invest it for 24%. And the next one, he could invest it for 24%. And then the third one that he received is around this time. So interest rates are high. So he gets to invest it for 32%. And let's say the next one, he's still able to invest it for 32%. And then thereafter, interest rates start falling. And then he invests for 25% and 25%. And then at the end of the 3 years, he receives his 100,000 back. So if you take all the money that he's going to receive over the 3-year period, okay, which means The 9,750 invested at 24% over 2.5 years. And then the next one invested over 2 years, and so on and so forth. At the end of the period, he will have 179,992, which translates to an effective annual rate of return on a compounded basis of 21.6%. So that's what the person will get, 21.6%. A little higher than the 19.5 because he got to reinvest his dividends his coupons at a higher rate. Okay. But what happens if this guy, out of panic, says, no, I'm not going to hold on to this instrument again. I'm going to sell. So he's selling today, 1 year after buying. He's selling today. And then what he wants to do is that he wants to use that money to buy dollars. So if he sells today, what is he going to sell? He's going to sell the instrument at 88.5% of its face value. So he's going to sell it at 88,500. But he would have had this coupon, the first 6 months interest that he received, that he has invested, and then the next 6 months interest that he has received. So when we add all the interest to plus the interest that interest has earned, right, to the 88,500 that he received from selling the bond, we end up at 109,170. And then he goes to buy dollars with it at the current exchange rate of 9.97. So he only converts that money to 10,900, let's say $10,950. Now, but if he had held on to the bond, his value at the end of the period would have been about 180,000. Now, so for him to break even, so for his dollar decision now to equate to what he would have done if he had held on to this instrument, then we are saying that the dollar has to depreciate in the next 2 years on a compounded basis by 27%. Okay, so if we look at that graph that we see the depreciation in the currency, where when we see a high one, we see maybe maximum 2 years of high depreciation followed by normal. We are saying that this time you are supposed to, after this year, let's say 30% depreciation this year, you're supposed to see another 27% depreciation next year and another 27% depreciation the year after, before this dollar decision would only equate to what would have happened if he had just kept his money. But most of the time, when people are taking the decision to sell and buy dollars, they are doing it out of fear. So no analysis at all goes into this decision. At a point in time, there is panic, and then they just decide, let me sell and buy dollars. And no analysis at all goes in. Hey, the CD used to be 6, it's now 10. Where is it going to? Is it going to hit 20 or whatever? Let me just sell and move out. Okay. No analysis goes into it. But this decision will mean that the CD will have to depreciate after this year, another 2 years of 27% compound. It means it depreciates by 27%, and wherever it gets to the next year from that rate, another 27% depreciation of the currency, just so that he gets to where he would have been if if he had just held on to his investment and reinvested the coupons. Now, is it impossible for the currency to depreciate 27% again? No, it is not impossible. Is it likely? No, it is very unlikely. The probability of that happening is very limited because we can go back, way back to times where we were not even a democracy and we did not have that happening. Now, but like I said, when we go through good times, people say, well, this time is going to be different. And during the .com internet bubble that burst in 2000, the talk was that, oh, this time is going to be different because it's backed by a new trend, which is internet, a different way. So things are very different. It's true, things were very different, but at the end of the day, how many companies stood? A very small percentage of the zoo of .com companies that were available. Okay, the same thing happens when there is bad times. When we have uncertainty, people say that, well, what is happening this time is very different from what happened the last time. So even though the last time we were able to get out of it, This time, we don't know whether we'll be able to get out of it because the circumstances leading to this decline is different from the circumstances that led to that decline. But the circumstances that led to that decline was also different from the circumstances that led to the previous decline. It would always be different. But what we have seen historically is that we always go through the cycles. Bad times don't last forever. In fact, even the Great Depression of 1929 did not last forever. So you will have to get to 27% depreciation. Now, so what happens if the depreciation is something more reasonable? So if the cedi depreciates by 12% on a compounded basis over the next 2 years, then in order to break even, you have to be able to invest the cedis in dollars and earn about 28.5% over the next 2 years. If the cedi depreciates by 15%, you have to be able to earn about 24.5%. If the cedi depreciates by 20%, you have to be able to earn about 14.5% over the next 2 years in order to break even. Now, so this is giving you a right perspective to look at, to be informed before you take decisions. We are not saying it's impossible, but we can only talk about probabilities because no one has a crystal ball to be able to predict what's going to happen in the future. But just look at probabilities and look at what the figures are telling you, and it will let you decide what steps that you should take. Now, so having dealt with our fears, now the next thing that we want to think about is that, so you have been able to deal with your emotions of panic, your fear. Now the question is, are there opportunities? Where do I look for to be able to, in a calm manner, take advantage of situations in the market and profit? Okay. Now, so we want to look at that, looking at the fixed income space, and then also looking at the equity space. So let's look at the yields on our Euro bonds, the foreign bonds that Ghana issued. The yields on our Euro bonds now are around 24.3%. Very, very high. Now, the bulk of this is driven by the fact that a lot of the foreign investors are dumping their bonds because, one, they cannot hold on to the bond because of our credit rating. And then also, two, there's a real risk that we may default. Remember that for these foreign denominated bonds, you have to pay for it in foreign exchange. Now, so if the fiscal state of your economy does not look too promising, then the risk that when it is time for you to pay back that bond, you will not have the dollars. And if you don't have the dollars, what you have to do will be to go back to the international market and issue a new bond and use the proceeds to pay back the old bond. But here's a case that we cannot successfully go back to the international market to issue bonds because of what is happening. There is very little investor confidence because of our credit rating. Now, so because we don't have access to the international bond market now, the risk that there's going to be a default is real. Okay, so in addition to the fact that foreign investors are dumping, there's also the real risk of default. But that has increased our Euro bond yields to 24.3%. Now, so there's a risk there, but there's also an opportunity there. Investors, the foreign investor market is very much waiting to see what steps that we are going to take. The government announced that we are in talks with IMF. The flip side is that it looks like they are not seeing a lot of aggression on our side to sign up to the IMF program and to go through. Okay. None of us is in government, so it's hard for us to tell exactly what is happening. But should we sign up to IMF, then foreign investor confidence will start coming back. Now, if it starts coming back, what's going to happen is that the yields on these bonds are going to decline. If the yields on these bonds decline, what it will mean is the prices of the bonds are going to go up. Okay, so there's risk there, but in it, there's also opportunity. And let's look at what is happening on the domestic bond market. I mean, it's crazy. Over the last 2 weeks, the yields 32%, 33%, 34%. This week, there was one bond trading at 38%. Just one particular bond. And it looked like there was one major buyer who was selling out. Very high interest rate. Remember the previous graph we saw that in the Europe and in America, inflation started going up, and for so long, interest rates did not respond to it. Nothing was happening. Interest rate was flat. But here, we only started seeing spikes in inflation this year. And immediately the spikes happened, interest rates have jumped to these high levels. Now, so what it means is that there are cheap bonds that you can buy today and get very good yields on your market. So you see down here, you see what the prices of some instruments are. Instruments that are maturing in 2026 and beyond are selling at less than 70% of their face value. So every 100,000 that you paid for it initially, if you want to sell, you are getting less than 70,000 back. Okay, so for 2032, you are getting about half of you are getting about 593,000 for every 59,300 for every 100,000 that you invested. Okay, so that means that if you have the money to buy today, you'll be paying 59,000 for something that upon maturity will give you 100,000, whilst you earn 19,000 on 100,000 every year on that instrument as well. Okay, so that's where that's what is happening now in our fixed income space. Now let us look at our equity market space. The equity market is a bit different because it is not a recent thing. Our stock market has been trading at very low prices for a long time, at least. We had very high returns over the last 6 years. We've had high returns, maybe only 1 or 2 years. But apart from that, we've had declines. Now, so this increasing declines, remember that there's a good reason why stock markets decline. Okay, so stock markets decline for good reasons. And then when that happens, panic takes over. And then the good and the bad all decline together. Okay, so the good reasons can be that we've not had a very stable macroeconomic environment. Local companies have really struggled to grow their business, etc. So that's a good reason for people not to want to buy domestic equities. But in the midst of that happening, you have all sorts of things happening to different companies in terms of share price decline. So I picked just a few equities to show you some figures. Now, let's look at dividend yields alone. So basically, the dividends that these companies have paid divided by their current share prices. We have some as high as 23%. In fact, for this particular equity, Access Bank, the share price has been increasing over the past years. But at the time that they declared the dividend in, I think about March or April, the dividend yield was about 40%, almost 40%. So prices have gone up significantly, bringing the dividend yield down, and it's still around 23%. And we have dividend yields of 16.7, 14, 12%. And these are, Societe Generale hasn't declared dividend yet, but when they declare, I am sure that we'll have dividend yields of at least 15% on Societe Generale. Now, but these are companies, most of these companies have shown strong growth in both revenues and earnings over the last 5 years. Okay, so you don't expect these companies to sell at such low valuations. And then you have the P ratios. Let's focus more on the inverse of the P, the earnings yield. Now, so the dividend yield says that if I receive dividend and I divide it by the share price, this is the return. The earnings yield is that if I take the net profit of the company, not the dividend, the net profit of the company, and I divide it by the share price, this is the return that I'm getting. So basically saying that if the company should pay out all its net profit to the shareholders, this will be the return that they are going to get on their investment. 64.9%, 65%, 52%, 28%, 60%. I mean, very high earnings yields. Okay. And this column, we call it price to book ratio. Now, in short, the price to book ratio under normal circumstances should not be less than 1. If it's less than 1, what it means is that if you are able to buy the whole company today, you don't have to run the company for 1 second. You can sell the assets, pay off the liabilities, and walk away with the profit. So for going concerns and profitable companies, price to book ratios usually are multiples, 2, 3, 4. But look at our price to book ratios. Some are selling as low as 1/3 of their book values. And these are financial stocks too, which means that their assets are mainly financial assets. So really, if you take their assets today, you can liquidate it. They have bonds, they have loans and things like that, you know. And a lot of them, apart from Access Bank, have also shown declines in share price. So the companies are growing their earnings and yet their share prices are declining just because people are uncertain. So that also creates opportunities. So what are we doing as Bora in the midst of this crisis and available opportunities? So what we are doing is that we are launching 2 unit trusts next month, sorry. We'll launch on the 15th of September. We are launching a fixed income unit trust and we are launching a balanced unit trust. The fixed income unit trust will be investing in government securities, fixed deposits, local government and statutory agency bonds, etc. And the balanced fund will invest in a balanced portfolio of fixed income and equities. The equities we expect will be maybe around 30 to 35% of the portfolio, and fixed income taking 70 to between 60 and 70% of the portfolio. Okay, so we think that this is a great time to launch because you have the advantage of coming in at a time where there's a lot of fear in the market, and you'll be able to come and pick these instruments at very low prices. Just one slide on what we are going to do differently as far as our collective investment schemes are. Now, the biggest challenge with collective investment schemes, why people don't like collective investment schemes, is that managing collective investment schemes involves some costs, which usually are much higher than the cost of your standalone portfolio. But we are aware that cost is very important. So that's where our focus is. So our management fee is 1.25, is the lowest you find on the market for both categories of fund. You will not find a fund in Ghana with a 1.25 management fee, which is either a fixed income or a balanced fund. You won't find one. And then also, we have no front loads on both of the funds that we are launching. Now, the front load is a certain percentage of your money is taken upfront and the rest is invested for you. So you have 100 cedis to invest. The fund manager takes 1 cedi and invests 99 for you. We don't think it's fair. Usually they say it's going towards promotion expenses. We don't think it's fair. So as our funds have no load, no front load at all. In addition to management fee, we also have very little expense ratio. All the other expenses are very small, very low trustee fees. 0.18 for the fixed income fund, 0.25 for the balance fund. Very, very little. Now, the balance fund will have a backload. Now, the backload is an exit charge for people who will stay in the fund for less than 2 years. Remember that there are shares in this, so we only want to attract people who have at least 2 years investment time horizon. So if you are not investing for more than 2 years, when you exit, there's going to be a charge. The charge is 3% if you exit in less than 1 year, and then 2% if you exit in less than 2 years. But here's the catch. For all the funds, the fund manager takes that exit charge. But we don't think that is fair, because you see, the reason why you are imposing the exit fund is that when people exit early, it distorts the investment strategy or the investment plans of the fund manager, which will negatively affect the performance of the fund for those who are remaining in the fund. Now, so if early exit is affecting those who remain, why should the fund manager take that exit charge? So we are saying we are not going to take the exit charge. We are going to put that exit charge in the fund so that everybody who is remaining in the fund will benefit from that charge that we have given to the person who has exited. So that's what we are doing, which is also very different. And then also the number 5 thing that we're going to do is absolute transparency. You know, I sit on a few boards, board of trustees for some funds, and they always bring proposals that they want to buy into some collective investment scheme, some mutual fund or some unit trust. And I keep asking them, do you have a copy of their trustee report or their custodian reports to know exactly what they have invested in? And most of the time they say no. Now, so what we have decided to do is that worst case scenario, at most on a quarterly basis, we are going to put what the trustee report is, the trustee report of all the assets that we hold, not the individual assets, but the breakdown of the assets. So how much is in government of Ghana securities, how much is in local government, how much is in this. We're going to put that summary on our website and update it at least every quarter to give you that transparency to know where the money is. And remember that this will be coming from the trustee, who is an independent one. For the fixed income fund, the trustee is Fidelity Bank. And then for the balance fund, the trustee is GT Bank. So we will put their report on our website. So we don't want to talk too much about this. So let's move on. Now, so how do we win? What is the win-win strategy? Number 1, I say avoid panic withdrawals and overreaction. Don't take a decision in panic. Don't just say, I want to sell my and you don't even know what you are going to do. Remember that investment you are holding is currently earning interest. So even if you are uncertain, if you don't know what you are going to do next, it is better to keep that money earning interest than to panic and withdraw it. Because if you withdraw it, inflation is just going to wipe out the value anyway. Okay, so don't panic and withdraw. Number 2 is that once you master the emotions of greed and fear, stick to your long-term investment plan, knowing that these cycles of booms and busts, they keep happening. These cycles of booms and busts keep happening. So there is definitely going to be a reversion to the mean. No one can predict how long the reversion is going to take, but we have history as our guide. So stick to your long-term investment plan and don't panic and move your money out. Last year, I was in my cousin's house in Virginia, and she opened her 401k statement. So that is her pension account in the US. For those who are not familiar, it is like a tier 3 scheme in Ghana. You know, she opened it for me and she said, when the market started falling, she moved all her money from the portfolio and put it in near cash. So, and that money that she was holding was earning 0.1%. Nothing. So zero. The money was not growing. Meanwhile, she moved the money after the market had declined. So she kept watching the portfolio week after week, kept watching the portfolio week after week, and then she kept seeing red. After seeing red for so long, she takes a decision, takes the money and puts it in cash. Right at the bottom of the market. She kept all that money in cash. And so now that I've gone to visit her, I said, William, you understand this, this guy advised me, blah, blah, blah. And now want to move the money back into equities. And I said, but look at what you have done to your portfolio. The market has recovered from the time when you move the money out. So I said to her that I'm not going to move all the money out. I'm going to move a certain portion of the money out for you and put the rest in lower risk instrument, because I have seen that your ability to manage risk is very low. But what I want you to promise me now is that you are going to stick to this plan. If you see that the market is falling again, do not touch your investments, but rather, as the market falls, you move a little bit at a time. Maybe every month you move a little bit of what is in the low risk ones back into the equities market over time, where you go back to what your portfolio used to be before. Okay, so stick to your long-term investment plan. Panicking does not solve the problem. Manage the emotions of greed and fear. You need to. You need to. And Buffett will always tell you, he says, this is not a game of intelligence. It is not that the person with the higher IQ does better with the person with the slightly lower IQ. It is not a game for the most intelligent, but rather it is the person who is able to manage the emotions of greed and fear. It is so critical that you get a grip and not panic and take rash decisions. And then the next thing is that don't try to time the market. In fact, there is no one who has been able to time the market successfully. So timing the market says that, okay, I'm going to buy dollars now. When the CD hits the maximum depreciation, I'm going to now sell the dollars and then come back and kind of invest. Or I'm going to hold cash now. When instruments get to the lowest price that they can get to, I'm going to now go into the market and buy. You cannot predict that. Rather, what you should do instead of timing the market is that you must always be in the market looking for great opportunities. Now, if you don't find good opportunities, do nothing. That's another thing Warren Buffett talks about. He says the ability for you to do nothing is also a strength, because there are times where people also, there's no opportunity, but you still want to put money in stuff, and then you end up losing money. If you can't find a great opportunity, just buy government bonds and then wait for good opportunities, right? So don't time the market, but look for good opportunities. And how do you determine what a good opportunity is? We are talking about assets that are fundamentally sound. Okay, so the fundamentals of the business, if it's equities, the business is growing its revenues, it has good market share, the industry is an industry that has a future, and then also, more importantly, you can find that asset to buy at very good, at a good price. If it's in the fixed income space, you are looking for fixed income instruments in credit-worthy institutions. Okay, so one that has very low risk of default, and then one that you can find. If you can find such an instrument at a bargain, then it's good. But do not try to time the market, because no one has ever successfully timed the market. Maybe you can get it right once, twice maybe, but consistently time the market right, it's not going to happen. Okay, so what do we do here at Bora? If you come to us for help with your investment, what will we do? We make sure that we profile you properly to understand who you are, what your investment needs are, and what your investment objectives are. And then we design an allocation strategy that considers your risk. If your risk is low, we will put you in low risk instrument. There's nothing wrong with having a portfolio of very low risk instruments. The only problem is when you don't know yourself. You think you can take risk and your risk appetite is low. So we want to understand what your risk appetite is and take investment decisions that align with that. So once we sort out your investment allocation, then we go to the investment selection. That is very important, because investment selection is everything. The fact that, fixed income doesn't mean anything. In the fixed income space, there are so many good fixed income instruments, but there are also very bad fixed income instruments. Whether you do well in the fixed income space depends on which assets that you select. Equities. There are people who don't want to touch equities at all, but there are good things that you can find in there if the person's risk tolerance allows us to add equities to his portfolio. So it's all about the security selection. Okay, then portfolio monitoring. You have to monitor the portfolio because fundamentals of businesses change. Something can be fundamentally sound today, and something can happen along the line that will make it not sound. Every quarter, we evaluate every counterparty that we deal with. Okay, everything that we invest in on a quarterly basis, we evaluate. That's why before the 2018 financial crisis, we had pulled out of every unsafe place. In fact, we started pulling out about 2 years before the crisis happened. When we started telling people to pull out, they didn't understand what we were talking about because we had seen the sign already that some institutions are going to go down. Okay, so we started pulling out long before the crisis actually happened. And then the last pillar is reporting. We make sure reporting is on time, timely, and accurate, and also convenient. So we have a portal where you can check what is happening to your portfolio at any point in time. So in conclusion, I'll say that history. So this is a quote from Shelby MC Davis. It says, history provides crucial insights regarding market crisis. They are inevitable. They will happen. You know, I told my kids that over their life, my kids, I have 2 teenagers and then one who is 8 years old. I told the 2 teenagers that over their life, they are going to have at least 3 major crises in financial markets. And crises in financial markets are always opportunities for wealth transfer. They have to make sure that they don't waste the crisis. Okay, it's going to happen. It's happened before, it's going to happen again. So it's inevitable. They are painful, especially when you have a huge exposure. But ultimately, they're surmountable. We always get out of it. We always, so your posture should be, how do I find good opportunities in these turbulent times? Thank you very much, Henry. Over to you. Hello, Henry.
Yeah, William, can you hear me?
Yes, I can hear you.
All right, thank you very much for the presentation. We have been once again enlightened, and we just have a few questions for you to respond to. Before we start the Q&A session, we'd like to say that this webinar is brought to you by investingh in collaboration with Bora Capital Advisors. You can always reach out to any of the parties if you want to join us. We'll make links available in the chat session here and before we end this meeting, so that you can get to know more about Bora and investingh. All right, let's quickly dive into the first question. It says that, what are the fundamental reasons for the depreciation of the cedi? Are there any reasons why countries like Cote d'Ivoire have more stable currencies than we do?
Yes. Okay, yes. So the Francophone West African countries, they have a very different system that keeps their currency quite stable because of their links to France and some policies that they have on their reserves and things like that. Okay, so what's happening there is very different. Now, what is the fundamental reason why our currency is devaluing? Every country's currency, the exchange rate of every country's currency is the price of that currency relative to other currencies. Your exchange rate is nothing, it's not too different from tomato prices. It's the reaction, it's the interplay of demand and supply that determines the currency. So, you know, there used to be, or I think there are still some countries that have fixed exchange rate regime where they say our currency is 1 cedi to $1 is fixed by fiat. But that doesn't work, because what happens is that if your currency is fundamentally weak, which means that if the demand for foreign currency is far higher than the supply of foreign currency that you have, your city is going to be, your currency is going to be under pressure. If you fix the exchange rate, black markets are going to develop. Okay, so these days, people don't, very few jurisdictions have fixed exchange rates. Rather, they allow the exchange rate to float depending on demand and supply. And then they use reserves to support it. So how do you use reserves to support it? When you sell your gold, you sell your cocoa, you sell whatever foreign exchange you get, you keep some in reserve, knowing that there are specific periods where your currency comes under pressure. In Ghana, when people are going to shop for, people are demanding currency for Christmas, okay, there's pressure on the cedi. And then when companies are repatriating their earnings after the financial year ends and they declare dividends and things like that, and they are repatriating earnings, there's pressure on the currency. So around that time, what governments then do is that they release money from the reserve, so that even though people are demanding a lot of dollars, they put the dollars in the market, so the currency becomes stable. Now, the other sources of foreign exchange that you can use is when you get foreign aid coming in, when you get foreign direct investments in foreign currency, and then also when you have access to international financial markets. Okay, so when you have access to international financial markets, that gives you foreign currency that will help you keep your currency stable. So what is happening in Ghana? What is happening in Ghana is that, one, a lot of foreign investors are leaving because of the downgrades. Okay, all the credit rating agencies are downgrading us, and because of that, a lot of foreign investors are not comfortable being in the investing in Ghana, so they are exiting. If they are exiting, it will mean that they need to convert whatever cedi they get from selling their investment to dollars to be able to send out. So that is that. Two is that on the fiscal front, we have not, our revenues have fallen short significantly. Our revenues are falling short. We have not cut down our expenditure. Okay, so we've not kept fiscal discipline. Now, so, and we also don't have the reserves to be able to back our currency. And we are also very much dependent on imported goods. Everything we find in our shops are imported. So we have not changed our habits. Okay. So we have all these things putting pressure on our currency. But now we don't have access to the currency. We cannot go to the Eurobond market to go and borrow again because of our credit rating. We don't have access to that Eurobond market. Okay. So once the demand for foreign currency far exceeds the supply, then you have the cedi depreciating from fundamental reasons. But in addition to the fundamental reasons, are all those people who have no business holding dollars, who are also speculating, and out of fear, selling their cedis to buy dollars. So those are the two main factors: fundamental factors and then also speculative reasons.
Okay, thank you very much, William. We have quite a number of questions. Johnny and Emmanuel, so they want to know what is the minimum amount that an investor can start with in relation to Bora's unit trust, and what are the procedures that investors have to go through to
Okay.
sign up? Yeah.
So the minimums during the initial public offering is just 100 cedis for both of them, and then thereafter you can do as little as 20 cedis a month. I mean, it's very flexible. So in terms of minimums, remember that unit trust, these are retail products. So it's designed such that everyone can take advantage of it. So that's one of the advantages, because you can be a small investor but be part of a big portfolio, so that you are benefiting from the professional management of a big portfolio whilst you're a small investor. Now, what is the procedure for joining? There's going to be a prospectus that will give you all the information about it, and then an application form that you will have to complete. We're going to put the application forms once we launch on the 15th. We're going to make the application forms available on our website. So you have to fill in the application forms and then send it back to us, and then you can go and can deposit the money in a bank. You don't need to physically come here to do that, using all the electronic platforms of payment. But we will do subsequent ones closer to the time, and even after we launch, where we'll go into details. That will just be purely about the collective investment scheme, how to sign up and all that. So we'll do subsequent ones to educate in details about it.
Okay, thank you, William. Let's take the next one. We have quite a number. So this one is from Frank. If the government's Eurobonds face a default risk, what is the likely? What might happen? Okay, the question. Okay, so if the government's Eurobonds face a default risk, what's the probability that domestic bonds they will not default on domestic bond payments too? Yeah.
Okay, so you need to understand that domestic bonds and Euro bonds are very, very, very different. Because for the Euro bonds, you need foreign currency to be able to redeem. You need foreign currency to redeem. For domestic bonds, it's internal. Okay, so I mean, if a domestic bond matures, the first thing that you do is that you issue another domestic bond and use the proceeds to service it. Okay. Now, unlike the Eurobond space, where there are times when you don't have access to the Eurobond market just because of your credit rating and things like that. You go out there and no one wants to touch you. You're falling below investor grade. It's not the same issue here. Now, for the domestic bonds, worst case scenario, okay, worst case scenario, government can print money to pay. That's not what you want to do, because if you print money to pay, you're going to suffer the consequences of it indirectly. But countries have done that because the consequences of printing money to pay, even though they are bad, it's not as bad as the consequences of default. Okay, so the two scenarios are completely different. The risk of default in domestic bonds is not zero, but it's way, way, way lower than the risk of default in foreign bonds, because you need to have access to the foreign exchange to be able to redeem those instruments. That's why IMF is, because when you are under IMF, then you have that support to be able to pay those instruments when you don't have access to the international market.
Great. That will lead us to our next question by EA. EA is asking, would the $750 million expected from the IMF lead to an appreciated cedi? And what would be the impact on interest and inflation?
750 is small. It's not going to lead to an appreciation of a cedi. What's going to do is that it's going to stop. It's like putting plaster on a sore. Eh? It's going to stop the bleed for a while, and that is going to discourage the speculators. Okay, it's not going to stop the foreign investors who have to exit. They have to exit because they have to be compliant. So those funds that have a SIP, statement of investment purpose, that says that you can only invest in jurisdictions that are investment grade, they have to be compliant and they would exit. So it won't stop them, but it's going to stop the speculators. So the 750 is not a lot. It will help, but that is not the long-term solution. So it's good as a temporary measure. We are putting just plaster on it, but we have to do the more long-term things, and one of it is being serious about the IMF program. because they're being serious about the IMF program. The other thing that is going to do is going to restore confidence. What we are facing is a crisis of confidence, a confidence matter. And you need to do things that will bring confidence back. And going at the IMF is one of the things that will bring confidence back.
Okay, great. There's another question from Monst. Yeah, he's asking, are you saying there's some kind of hope for the city? That's his question.
Okay. So all I'm saying is that no one has a crystal ball to look into the future, but we have data. So I'm saying that we have had periods worse than this. We've had periods that looked more dire than what we have today. And the worst we have seen, it lasted 2 years. Okay, so all I'm saying is we don't have a crystal ball. No one has a crystal ball, but we have history to guide us. Bad times don't last forever, and good times don't last forever also. We always go through these cycles. So it's a cycle. Don't react as if this is a permanent situation that you are in and take decisions as if this is permanent. Because if you do that, it's going to cause you to do wrong things like buying dollars and keeping dollars, which would never give you an edge long term. It would always put you in a worse off situation.
Okay. Thank you very much, William. Nenyi is asking, what is the rationale for adopting a unit trust instead of a mutual fund structure? That's for Bora.
Yes. So mutual funds and unit trusts, they are very similar in the way they operate in practice. But there's one marked difference. The marked difference is that it's the legal structure. The mutual fund is a private limited liability. Sorry, it's a public limited liability company. So it's a company that's only one thing, invest in other companies. Now the unit trust is also investing in other companies and financial assets, but it is not a private limited it's not a public limited liability company, it's a trust. Now remember that in my presentation I said the number one thing that we are focusing on is cost. So the main thing that led us to go for the unit trust system instead of the mutual fund is that there's one additional layer of cost that a mutual fund has that a unit trust does not have, which is board fee. So we wanted to eliminate that because you can have the corporate governance without that structure. Okay, you can have the corporate governance without that structure. You have a strong investment committee, you have the oversight of the trustee. So you can have that without a board structure and yet eliminate the board fees. So the main rationale was to eliminate one layer of fees that would impact on returns. So everything we are doing is to make sure that the fees are as low as possible so that the investors get the maximum returns.
Okay, great. There's a question. The person wants to know why MTN was not part of the listed companies that you put in your scenario analysis.
Okay, so I didn't put all the companies. I put the most undervalued. Okay, so I'm not saying. So I'm not saying if the company is not on my list, it's bad. No, I just wanted to show undervaluation. Okay, so I showed the most undervalued equities on the market. MTN at this current price is not one of the most undervalued securities. That's why it's not on my list.
Okay, great. Thank you. Kwesi wants to know, is the exit fee the same for both the fixed income and then the balanced unit trust? That will be for Bora.
There is no exit fee on the fixed income fund. It is only the balanced fund that has an exit fee, only because we are targeting investors who have a minimum of 2-year time horizon. In fact, we want people who want to invest 3 years, 4 years, 5 years in the balanced fund. Whereas the fixed income fund, it's satisfy people who are short, medium, and long term. For the balanced fund, we want medium to long term investors. So it's only the balanced fund that has an exit.
Okay, thank you. Kofi Arthur wants to know, doesn't redenomination give a nation a false sense of parity of their currency with other convertible currencies? And as a result, it makes it more of optics than restructuring. I don't know if you get the
Yes,
question.
redenomination is not restructuring. I mean, redenomination is done for practical reasons. So in our time where we did redenomination, it was for practical reasons. Anything you are going to buy, you needed so much currency. You're going to buy something, you need a bag full of currency and stuff to go and buy it. Okay. And printing money costs the country a lot of money to print a lot of money also, you know. So for practical reasons, it made sense at that time to redenominate the currency. Okay, but that's not a cure for anything. You have to be fundamentally sound. You have to be fiscally disciplined. You must have an economy that is robust. You must have, I mean, in our case, we are price takers. The things that we export are unprocessed, so we are price takers. We take commodity prices on the international market. And everything that we import is processed, is finished product. So we take the price of the manufacturer. So we have an economy that is not robust. Okay, so you need to address the fundamental things. So, for instance, the stability of our currency. If you have access to the international bond market and you are issuing a lot of bonds, and because of that you have foreign exchange, and you use that to support your currency and you don't get depreciation. It's not a solution. It's a temporary fix. What happens when you don't have access to the international bond market? Then you get exposed. Okay, so there is no hiding from doing the hard fundamental work. Okay, so yes, to that extent, I don't think redenomination was done to fundamentally change the structure of the economy. It was done for practical reasons, and it made sense at that time practically to do it. But that is not a solution for creating a sound economy.
Okay, thank you, William. We have another question from Kenneth. Most mutual funds have allocations in other firms, i.e., fixed deposits. Why won't investors invest directly, but rather give the money to these funds who end up charging them fees?
Okay. So good point. So first of all, let me back up. Now, the regulator, the Securities and Exchange Commission, has come up with a directive that says that all retail funds must be put in collective investment schemes. And you ask, why is the regulator saying that when they know that these investors can go directly to these firms? But what happens when investors go directly to these firms is that most of the time they'll have all their money with one institution or with two institutions. So they are very heavily weighted in particular institutions for the retail investors. When something bad happens to one institution, all their portfolio is at risk. But if you join a collective investment scheme, you won't have more than 10% of your money with any one particular issuer, apart from government securities. You will not have more than 10%. By law, you can't have more than that. So now the exposure becomes very limited. Now the cost component is very important. And as an investor, before you join a collective investment scheme, you must find out what the cost component is. So that part of your question is very legitimate. And that's why here our whole focus has been on how to drive down costs. Okay, so we give you the benefit of a diversified portfolio. A benefit, so another thing is that when you go as an individual and you're going to say invest 10,000 cedis, you cannot go and negotiate with 10,000 cedis. But if you are part of a pool that is investing 10 million, that fund can go and negotiate on that 10 million. And the extra return that they are going to get will likely be more than the fee that you are being charged if they are keeping their eye on cost. Okay, so you would get that benefit also. And then there are other little things. So for instance, you have all your money with one one issuer, let's say Bayport, and then for some reason you need money urgently, so you need to withdraw money before maturity. You will be paid, you will be charged a penalty. But in a collective investment scheme, the portfolio usually has about 5% of the assets in very liquid instruments. So they don't need to go and make a withdrawal for any place where they will be charged a penalty for early withdrawal, but they'll still be able to give you the liquidity. So there are benefits. But your fundamental point is clear that yes, you as an investor, you have to keep your eye on cost, especially front load. If you have to avoid schemes that are charging you front load because it's very punitive.
Okay, thank you very much, William. I'll be combining questions from Nkrumah and Eddie. They want to know, what would you recommend for holders of long-term GOG bonds? Should they sell and reinvest or keep it?
Okay, so I would say that um, call us. There are times where it makes sense to sell and reinvest. There are times where it doesn't make sense. But before you take that decision, you have to model it. Okay, so basically, we need to put all the information on that bond in a model that we have in-house. Okay, what is the coupon on that bond that you are holding? What is the price today of that bond? If we sell it today, what are you going to get? And what are we going to invest in? The next bond we are going to buy. And then we'll analyze it. If you hold what you have and reinvest the coupons that you are receiving at this higher interest rates, this is the return that you are going to get at the end. If you sell and take a loss today and invest in this particular bond that is giving you this kind of return, what is it going to be at the end? So there are times where the analysis makes it profitable for you to sell and reinvest, but there are times where it does not. So there's not a wholesale advice that I can give. What I can say is that get in touch with us. Let us know the particular situation you are dealing with, and then we'll be able to advise you from an informed point of view. Remember that we are not taking any knee-jerk reactions here. We are keeping calm, doing analysis, and taking advantage of opportunities that arise in the market.
Okay, great. For those who would like to contact Bora, you can always send us a mail at info@boraadvisors.com. info@boraadvisors.com, or contact us. We'll make the details available. If you've not registered for this webinar, please do so on the Bora website, www.boraadvisors.com, so that you'll be registered and added to our list of subscribers. Thank you. And William, let's continue. We have a few more questions. George wants to know, can you explain in layman terms why it will be prudent for a UK resident to convert their pounds into cedis and invest in Ghana?
Okay, so again, there is no bullet answer to say it makes sense for a UK guy to convert to cedis and invest, etc. No. You see, the question is, if you invest in UK based on you, the particular investor, what your investment risk, your risk appetite is, etc. What will you be investing in the UK? If you invest in the UK, what will you be investing in? Because that which you'll be invested in will determine what the expected return of the UK investment will be. Then we'll look at what is an appropriate investment for you here in Ghana based on your investment profile. What would you invest in Ghana? What is the expected return of the Ghana investment? Then we also look at expected depreciation of the currency. We factor in expected depreciation of the currency. Then now we can compare the two and determine whether in your particular case, it will make sense to invest in UK or make sense to invest in Ghana. Okay, so you need to, it's on a case by case basis. But what I want to say to those who live outside of Ghana is that try and understand the market where you are. Try and understand the market where you are so that when there are opportunities there, you'll be able to identify it. Because most of the time, what we see is that the reason why they don't find any opportunities where they are is that even though they live in that country, they are not too invested in investment opportunities there. So immediately they think about investment opportunities, they start thinking about Ghana because it's Ghana that they know. Okay, so try and understand that market also, so that when you are taking a decision, all factors have been considered. So there's not one bullet that says invest here, invest there. But generally speaking, if we use history as a guide and we take comparable instruments, so like if you take, well, equities, we cannot use equities over the last 10 years because our equity market has not done well over the last 10 years. So equities are out. But if we take our fixed income space over the last 10 years and we compare to, I think even both fixed income instruments and equity instruments abroad, and we factor in the depreciation of the currency, it appeared at that for that period that converting the currency and investing here looked like it made sense. However, history is only a guide. What has happened in the past is not a prediction of what's going to happen in the future. So on a case-by-case basis, you need to do the analysis to take the decision. And then another thing I say to those living abroad is that if your plan is to invest that money and use the money in Ghana, it's very different from if your plan is to invest that money in Ghana yet use the money abroad. Because if you want to invest the money in Ghana and ultimately use the money in Ghana, then you don't have that worry, that extra worry about what the currency depreciation would be. Okay, so your worry becomes what is your rate of return against what expected inflation is. But if you are thinking about repatriating the money, then you have an additional layer of exchange rates to worry about.
Okay, thank you, William. Ellie is asking, why didn't Bora start an equity trust if they thought there was an opportunity in equities?
Yes, okay. So the reason why we chose the balance fund over an equity fund, well, we could have done all the three, but you see, for the balance fund, there's always this rebalancing clause in balance funds that says that so in our prospectus, we say under normal market conditions, we're going to have 45% in equities and 55% in fixed income under normal market conditions. However, the prospectus also makes provision for a 20 plus or minus 20%, which means that if market conditions allow, we can go as high as 65% in equities, which would look like an equity fund. But on the same side, if market conditions are not attractive, we can do as low as 25% in equities. So we kind of think that having a structure like that is more beneficial than having a pure equities fund, where at any point in time, you have 90-95% in equities, irrespective of what is happening in the market. So this allows you that flexibility. So that's why we chose the balance fund over a pure equity fund.
Okay, thank you, William. Francis is asking, the interest rates for treasury bills at the moment is higher than the returns made on some unit trusts. Will it be advisable to move funds into treasury bills?
It appears so. Okay, so the reason why the returns on the fixed income unit trusts are lower is that even though they are investing currently at high interest rates, they are buying instruments that are earning 30%, 32% now. They still have a lot of instruments in their portfolio that they bought that had yields of 19%, 18%, 16% thereabout. Okay, so the return is the weighted average of all the instruments in it. So if you sell and you go and buy government securities now, yes, it appears as if in the short term you're going to make some returns. So on the face of it, it appears so, especially if you are only going to buy government securities. So then you are not worried about risk, because if you take all the money out and you go and buy FDs at places where you've not done analysis, then now you are risking default, right? So it appears so for now. That's why we are excited that we are launching now, when we can get the instruments at the high rates of it.
Great. Austin is asking, does Bora have any investment opportunity in foreign currencies?
So we are working on it, but for starters, it's only going to be available to our high net worth investors, because the opportunity we have is for investing in foreign equity space. And because of the volatility there, we don't want to, we want to only limit it to people that we are aware, we have assessed, and we know that they have the risk tolerance for it. And that is our private wealth clients. So for now, that is what we are working on. And it's still working.
All right.
Yeah.
Great. Thank you, William. We'll take the last two questions. The first one from Randy is asking, how attractive is the real estate market in these challenging times?
Yes. Okay. So my answer to that is the same as every other class of security. Now, you see, when you say real estate, it's a very broad thing that you're talking about. You can make very dumb decisions in real estate now. You can make great decisions in real estate. Back to the point. Look for investments that are fundamentally sound, that you are getting at good rates. Now, so you say, oh, real estate opportunity, real estate opportunity, real estate opportunity. And then you go and buy a house, let's say at Anya, or I don't know, somewhere, okay, where the income you are getting from the property compared to the price you pay for it is so small, okay? Compare that to someone who buys like a studio apartment in Cantonment or something, and puts it up on the market for people who are doing short-term stay. And I know that some of those properties, the investors there are getting rental yields of about between 10 and 14% on the dollar for the small units, the studio apartments and the one-bedroom apartments. But someone will take, instead of spending, let's say, $90,000 on a studio apartment in Cantonment, will go and use that $90,000 to buy a 3-bedroom house in some corner somewhere. And then the rent that you are getting for that 3-bedroom house is one third, or one third guys is a lot, 1/10 of what you get on the studio. It's all about the analysis. If what you are doing is investment, you need to do analysis to take a decision. So real estate doesn't mean anything. What real estate transaction are you doing? Does it make sense? So when you do it broad like that, we cannot answer, because some of it makes sense, some don't make sense. You need to do the analysis before you take a decision.
Okay, I guess Randy will have to contact you after the webinar. There were a few questions I missed from YouTube. I'd just like to ask them quickly. Will Bora launch a mobile app alongside the unit trust?
Yes. So it's not going to happen on the day of the launch, but it's being developed as of now. So we were hoping that we will launch the two together, but we will launch the fund first, and then the mobile app will follow. But it's being
Okay.
tested on. But in the meantime, we have our web portal, which is already up and functioning.
Okay. So the portal acts just like a mobile app would.
Yes, except that, well, you can also use that on your mobile phone though. So yes, you have it on the go, but it's a web portal. Harry, hello, hello.
William, can you hear me?
Yes. So I don't know whether I was the one who went
Sorry,
on
I just
earlier.
dropped off quickly.
Okay.
I don't know what happened. I think my internet connection. Okay, so I was asking, how long do we, that's Ghana, have to be in the IMF program? That's Osei's question from YouTube.
Okay. So you will only know that after the negotiations have been done. But typically IMF programs last anywhere from 4 to maybe 7 years. I don't know, but it varies from program to program.
Okay, great. Then I think I exhausted all the questions. The very last one, which I intended to ask, was describe how an individual can invest 300,000 in Ghana. That's from Frank. So that will be our last question.
So again, there's no which individual, what is his investment time horizon, what's his risk profile. So every
Frank says he's risk averse.
aha. Okay. So risk averse.
Sorry. Yeah.
What is what is his investment time horizon? Is he investing for 1 year, 2 years, 3 years? But generally, once you start from the premise of your risk averse, then you should know that your portfolio is going to comprise of government of Ghana securities. It's going to comprise of local government and statutory agency instruments, and a few certificates of deposit or fixed deposit with very secure financial institution. Mostly we deal with only the guys who lend money to people on government payroll. Okay, so once you are risk averse, your portfolio is going to comprise of these three securities. The weighting, how much is in government, how much is in local government and agency, how much is in payroll lenders will depend on the discussions that we have. And then now when you go to all the various asset classes also, whether we're going long, medium, or short depends on your investment time horizon.
Okay. Thank you, William. In relation to such questions, I think it will be better for you to reach out to us. Bora offers free, and I mean free, investment advice,
And financial planning
advisory,
and
and
financial planning.
financial planning services to all individuals. So whether you're a client or not, you can always reach out to us, contact us. Our mobile number is 050-77-123-43. 050-77-123-43. I'll type it in the chat session so that you can quickly get it and then reach out to us. It's always on the flyer. You can always call us and then we will have a conversation with you. This webinar is proudly brought to you by investingh, your leading provider of financial news and education in Ghana, in collaboration with Bora Capital Advisors. Bora is one of the top 5 fund managers in Ghana with an AUM of about 3 billion cedis. Bora provides excellent financial and investment solutions that are tailored to the needs of individuals and institutions. You can always contact Bora at www.boraadvisors.com. There is a portal there that you can reach out. You can also contact us 05077 123 43.